gold is trading around $4,900. But on COMEX, for December 2026, there is a massive open interest in call options at $15,000, $17,000, and even $20,000 per ounce. If gold get up to $15,000, then they start making money in a big way. Not a typo. This is 15,000, 20,000, and gold is at 4,900. These people are seeing something that we don't. I mean, keep in mind it could be for other reasons as well. They could hedge themselves. So today, let's take a look at it. And understand a few things. Why this chart? What this chart actually shows you, how to read it properly, what open interest really means, what max pain tells us, and whether this is smart money positioning, and what kind of world would even allow $15,000 to $20,000 gold. And you'll understand whether this is speculation, hedging, or a warning signal. Subscribe, like. This channel is built for people who want signal and not noise. What does this chart actually show you? The horizontal axis is basically shows the strike prices. They go for $4,000 on the left all the way to $20,000 on the right. Each vertical bar represents open interest, which means how many option contracts currently exist at that strike. Now, just for those that don't know, each contract controls about 100 shares. Okay, so blue bars are puts and white bars are calls. Puts meaning I don't like it, I'm very bearish about this thing, and white means I am very positive. I will make money if this thing goes up, if gold goes up. Most of the action, obviously, as you could see, is on the far right, between $19,000 and $20,000. Now look at the orange vertical line. That line marks the current gold price, around $4,900. So we are looking at option strikes that are 3 to 4 times higher than today's price. That is kind of a weird positioning, right? That is deep out of the money call buying. I mean, for you to make money by the end of the year, you're expecting some huge amount of movement. And what is open interest? Well, open interest simply means how many option contracts are currently open and active. So if the open interest is rising, it means new positions are being created. And by the way, not to get off topics, but right now, there is also a huge amount of open interest in silver. And in fact, there's not enough silver to meet the demand should all these contracts. And that's at the end of February 27th, actually. And I've been talking about this to my members. So we'll be monitoring the situation. If open interest is falling, it means positions are closing. And what we're seeing here is concentrated upon open interest at extremely high strike prices. And that matters because when open interest clusters at extreme strikes far from the current price, it usually reflects one of three things. One, extreme speculation. As I said before, institutional hedging or tail risk insurance. So we need to figure out, what are these people trying to do here? Because this is kind of extreme. On the left side of the chart, you will see a label. Max pain. You see the purple label? What does that mean? Well, max pain is the price where the largest number of options expire worthless. It's the level that caused the most financial loss to the options buyer. Right? That tells you something important. The current options market structure does not expect gold to finish anywhere near 15 to 20,000 by expiration. So why buy them? Because these are not normal directional trades. These are asymmetric trades. So let's do simple math. Gold is at $4,900. Okay? To reach 15,000, gold would need to rise roughly 3 times. To reach 20,000, it would need to reach 4 times. That is not normal bull market move. That's like systemic event. Somebody mentioned war. That's war territory. That implies a currency crisis, a sovereign debt instability, severe inflation wave. I mean, okay, let's go through one by one. I mean, currency crisis. The dollar's been losing a lot of its value, but I don't think it's in currency crisis yet. They lost about 8% over the past year against the euro, and every day we look at the dollar index, see where it is to make sure it doesn't get out of whack. Okay, sovereign debt instability. Well, not so much right now because everybody keeps refinancing and refinancing, so we don't have that issue yet. Severe inflation wave. All that thought. I did a video not too long ago that shows that this inflation could potentially hit us because this country is growing. The U.S. is growing very fast, and they're thinking of lowering the rates. Loss of confidence in fiat systems, so we don't believe in currencies. Geopolitical rupture. Think war. Think something out of Iran get out of control. Central bank balance sheet expansion beyond control. 37 trillion so far. So this is not pricing in a normal cycle. This is something, basically this is pricing in something breaking. Now, could these be just cheap lottery tickets? Possibly. Deep out of the money calls are cheap. That's exactly how Spitznagel, who's mentioned in this book, by the way, The Chaos Kings, made a tremendous amount of money during COVID. Because he basically bought lots of cheap out of the money saying that they're going to close the country. And people laughed at him. Not any longer. Institutional players sometimes buy them as optionality. This is the whole thing with the black swan, with the fat tails, right? We're hedging something that's an unlikely event. So if gold goes nowhere, they lose small premium. Doesn't cost them too much. If gold explodes, they make 20, 30, 50 time returns. That is convexity. And I do talk about this with my members, as I did show them an example recently of a position that I took on the S&P 500. In portfolio terms, this is known as tail risk hedging. And serious funds do this. This is real big money. This is how you make a lot of money in the market. Why December 2026? Well, December 26 is far enough out of to allow a recession cycle to develop, monetary policy to pivot, debt refinancing stress to appear, geopolitical events, right? You have enough time for things to go bad. Who might be buying? Well, retail traders typically do not cluster the way that way. They don't coordinate high volume deep tail strikes. People don't really even understand, what a tail risk is. So it's very unlikely this is what's happening. So large open interest blocks usually come from hedge funds, Spitznagel, Black Swan author, commodity trading advisors, sovereign funds, large macro funds. They are players who think in probabilities, not headline, which is something I try to move my my members to. Thinking in terms of forget the narratives, forget the headlines, understand the probabilities. And they often buy protection before the event, not after. So is $20,000 gold possible? Historically, extreme gold moves have happened during monetary regime shifts. In the 70s, when gold went from $35 to $800, that was over 20 times. Why? Because the monetary system changed. Inflation surged, confidence broke. So while 20,000 sounds like insane today, under severe currency devaluation scenario, it becomes arithmetic, not fantasy. The debt factor. Global sovereign debt is at historic highs, and not just in the US, everywhere. So if real interest rates stay elevated while debt rolls over, pressure will build. That is why the U.S. is trying to lower the 10-year yield, which we also monitor on a daily basis, which right now is around 4.8%. 10, a little bit less than that, 4.06, 4.08. Central banks historically respond to pressure by cutting rates, expanding liquidity, and monetizing debt. Gold reacts strongly to those conditions. These option buyers may be positioning for policy reaction, not price prediction. They say, you know what? There's too many balls in the air. Something's going to break. And we just found out very recently about the tariffs. But understand this. Markets hedge against low probability, high impact events. Just because someone buys insurance doesn't mean their house is on fire. It means they understand risk. And that's what makes this chart very fascinating, because it reflects preparation, not panic. Well, first of all, you should not chase extreme narrative like this one. Instead, you should ask yourself, is my portfolio resilient? Do I own real assets? Do I understand currency risk? Am I diversified? Extreme option buying is information, but it is not a guarantee. So, in conclusion, this chart tells us something very simple. Someone is willing to pay today for protection against a world where gold triples or quadruples. Doesn't mean it's going to happen, but it means someone believes the probability is not zero. And in market, probability is everything. Don't forget the thumbs up, and don't forget to subscribe.